McDonald's, a global fast food giant, boasts an empire of more than 40,000 restaurants worldwide, with over 13,000 locations in the United States alone. Their annual revenue surpasses a staggering $23 billion. However, despite the pandemic, which saw profits rise, the company faced challenges such as rising operational costs and supply chain disruptions. To cope, they increased menu prices, leaving many wondering how such a behemoth could struggle. In this video, we'll delve into why this fast food titan faces an unexpected wave of bankruptcies in 2023. But before we do, remember to show your support by giving this video a thumbs up and subscribing to our channel for more. Now, here's where the plot thickens. Despite being the undisputed king of fast food, a surprising fact emerges. 95% of McDonald's restaurants in America are independently owned. The conflict between corporate and franchisees has been escalating, with many operators reaching their breaking point. McDonald's stringent rules and costly demands have put franchisees in a tough spot. The company's anti-franchisee policies appear to be eating away at its core. In April, McDonald's announced tighter control over its franchisees, distancing itself from joint employer obligations, which significantly reduced its legal liability over franchise owners' actions. The National Owners Association, NOA, representing over 1,000 McDonald's operators across the US, voiced their discontent, saying, "We want our independence. If McDonald's doesn't want to be a joint employer, they need to stop acting like one." Corporate implemented changes included a new grading system, more frequent inspections, and a revamped approach to granting 20-year franchise licenses, emphasizing that they are earned, not given. Operators, despite earning between $100,000 and $150,000 per location, struggle with annual expenses ranging from $1 million to $2.2 million per location. This means they only see a 10% return on their investment each year. While corporate executives enjoy substantial bonuses and salary raises, operators are left to shoulder the burden of costly renovations, such as new furniture, decor, counters, exterior redesigns, digital kiosks, and improved drive-through lanes. McDonald's dictates the changes, but only covers 50% of the remodeling costs. Since 2018, the company has spent nearly $6 billion on renovations, leaving another $6 billion for franchisees to cover. This translates to an eye-popping $350,000 renovation cost per store on average, nearly 70% of their store revenue over 5 years. Meanwhile, during this period, franchisees' sales and profits often stagnated or declined. Older locations that hadn't renovated in decades faced even more daunting expenses, sometimes up to $1 million. To make matters worse, these operators had to foot at least $500,000 of the bill themselves, pushing many into debt to meet the company's redesign demands. Ironically, it's often these older locations that were struggling financially to begin with. Adding to the turmoil, in the last 2 years, nearly 28% of McDonald's franchisee-owned locations have changed hands, compared to only 12% of Burger King's. Worst yet, since 2019, almost 34% of McDonald's restaurants have either been sold off or shut down. Operators argue that the company is deliberately crushing small franchisees, leaving many struggling to survive. The clash between the fast food giant and its independent operators is at the heart of this unfolding story, where corporate decisions are reshaping the landscape of the fast food industry. Stay tuned as we delve deeper into this intricate web of challenges and controversies that's shaking the foundations of McDonald's empire. To shed light on the alarming situation within McDonald's, it's crucial to understand that the company's actions are driving small operators to sell their most profitable locations to larger corporate-owned franchisees. The National Owners Association, NOA, has released a document claiming that McDonald's is essentially pressuring smaller operators into compliance, threatening them with bankruptcy and asset loss if they don't comply with corporate demands. For around 40% of franchisees, McDonald's new financial requirements may result in the termination of their long-standing leases, as the company's ever-increasing expenses prevent these stores from reaching their profit targets. In simpler terms, if franchisees fail to meet corporate expectations, they risk having their contracts cancelled, leading to the loss of their entire investments. Astonishingly, 1 in 4 McDonald's operators faces the specter of bankruptcy, largely due to the company's actions against them. To gauge the extent of the tension between McDonald's and its franchisees, A survey conducted by Kalinowski Equity Research asked operators to rate their relationship with McDonald's on a scale of 1 to 5, with the average operator giving a dismal rating of just 1.19. This marks the third worst rating since 2018, when the remodeling plan was introduced, coming closely behind September 2021's average of 1.18, a time when labor and supply chain issues were being blatantly disregarded by the company. Adding to the strife, in recent years, McDonald's imposed a new technology fee of $70 million on its operators. Nowhere alleges that this money did not lead to any substantial technological improvements in the restaurants, but was instead used to offset corporate debt. Many franchisees have taken legal action against the company, demanding the elimination of this fee, but the courts have consistently ruled in favor of McDonald's. It seems as if McDonald's prioritizes shareholders above all else, including the franchisees who diligently run their stores and the loyal customers who have embraced the brand for its affordability. However, their strategy of expanding their business at the expense of operators may not be a sustainable one. If enough franchisees decide to part ways with the company, the entire business model could be at risk. Surprisingly, for a company renowned for its burgers, fries, drinks, and iconic symbols that have become ingrained in American culture, the food itself is not its primary product. You and I as consumers are not McDonald's true customers. This revelation might be shocking to some, but one quote from the company's former CFO explains it all. We're not technically in the food business. We're in the real estate business, as emphasized by Harry J. Sanborn. McDonald's realized long ago that selling burgers, even in the billions, with a profit of less than 15 cents per burger, doesn't generate substantial revenue on a corporate scale. However, if they own the properties where these burgers are sold, the financial landscape changes dramatically. Essentially, McDonald's grants operators the privilege to use its brand, enabling the company to profit immensely from the hefty leases paid by these franchisees. This lease-centered approach has enabled McDonald's to nearly double its worldwide revenue since 1990. Today, McDonald's boasts the largest market capitalization of all fast food chains, twice the size of Burger King, and over 20 times larger than Domino's. This isn't because McDonald's sells twice as many burgers as Burger King or runs operations that are 20 times larger than Domino's. It's because its business model, centered around leasing rather than sales, is incredibly attractive to investors. While this leasing-centric model may be lucrative for corporate, it has been detrimental to franchisees. When the pandemic prompted the Federal Reserve to lower interest rates to near zero levels, real estate prices soared nationwide. Given McDonald's status as a real estate business, its total assets skyrocketed. However, this presented a major challenge for operators who were struggling to pay minimum wages and saw guest visits plummet. While corporate was reaping the benefits of some of its best financial results in years, franchisees were left to shoulder the risks of managing a low-margin restaurant business during economic downturns. On the consumer front, there's dissatisfaction as well. McDonald's push for pricier burgers has failed to resonate with customers. Despite the average ticket prices surging by approximately 15% over the past year due to higher menu prices, fewer people are frequenting McDonald's locations each month. Even more concerning, there are fewer repeat visits in a month. In simple terms, customer loyalty is on the decline, a fundamental pillar that has supported McDonald's brand since its inception in 1955. Regrettably, McDonald's serves as a stark example of how a once great business can decay from within due to its own avarice. With younger generations increasingly prioritizing healthier food options, it's foreseeable that the fast food giant will gradually fade into the background, if not collapse, as interest in becoming a McDonald's franchisee wanes. In fact, it's becoming clear that if any of these operators had invested their money in the S&P 500 rather than McDonald's, they'd be enjoying significantly greater profits. This is a reality more and more people are waking up to, and it's a contributing factor to the impending decline of what was once the greatest fast food chain America had ever seen. Guys, thank you so much for watching. Please do make sure to subscribe to the channel as it really helps us out.